Right people, welcome back to the AA Trading Weekly Macro Commentary. Now I'm going to preface this entire video by saying the main focus is going to be macro. I mean, there's a reason I'm calling it the macro commentary now as opposed to just the weekly commentary. And the reason for that is I feel as though, there's a lot of people that trade very different ways, right? And it makes sense. I mean, I don't necessarily care what technical analysis you subscribe to. My main goal is to make sure that you guys get the overall macro picture correct, okay, and that you're aligning yourself fundamentally. That's the main thing, and that's after that, it's sort of just using your technical analysis to refine your entry and sort of align on whatever time frames you're trading on, okay. So yeah, I'm going to focus a lot more on macro. There might be a slight hint of technical analysis here and there. I mean, I'll let you guys know certain areas that maybe I'm thinking I would like to see an asset trade to, but overall, the main thing is macro. Okay. Now, let's go through what actually mattered in the markets last week. There was quite a lot of economic data released, right? But if I'm being honest, I don't want to go through every single figure because realistically, not every single data print actually matters, right? We want to focus on the big ones, the ones that are genuinely going to cause true upside pressure or sell side pressure in these markets. Okay, so main theme, if you guys are taking notes, it's probably best to, or just keep it in the back of your mind. The main theme last week was this conflict between weakening growth and sticky inflation, right? Now, if you're new to sort of macro analysis, fundamental analysis, how I would view that is just understand that these two objectives do not gel together, right? It's not a good thing for economies, right? Now, we're seeing some signs, of course, that economic activity is slowing, particularly in areas like the US housing market and the UK consumer market, right? Now, at the same time as that's all going on, we're also seeing inflation not disappearing as quickly as the central banks would like it to sort of disappear. You know, they obviously have their respective targets in mind, and they want us to get down to those targets as quick as possible without jeopardizing economic activity, okay? But of course, with those two objectives and the way their economies currently are performing, that's quite a difficult environment. That's the main thing. It's a difficult environment for central banks because they're effectively stuck between these two objectives, right? They're stuck between this. They're trying to get down to these low inflation numbers, these low inflation targets. Sorry, but of course, at the same time, their growth is weakening, right? And that's obviously not a good thing. So, what they're asking themselves, these central banks, is essentially, do we keep these rates high? Do we keep our interest rates high to control this inflation? Or do we start to ease on our monetary policy to essentially counteract this weakening growth, right? And that was a very important aspect for the Federal Reserve last week, right? So I'm going to focus on four major areas. I'm going to focus on the Fed and US data. I'm going to focus on UK inflation and the Bank of England and sort of let you guys know my opinion on where their heads are at. Eurozone growth and inflation, of course, and a big one, I know this is probably something that most of you guys are tuning in for, is Treasury yields. Okay, we had, of course, a big announcement last week. Sort of go into depth and detail regarding what the announcement was, how it can affect markets, and how to best align yourself going forward, right? But of course, we're also going to talk about oil and the ongoing geopolitical risk. And then my plan is, of course, to sort of bring everything together, look at what this means for the DXY, look at what it means for gold, indices, GU and EU, right? Those are the main markets I'm going to be focusing on. But of course, this is applicable to most markets. Right, so the Fed, most important story. I mean, the biggest event from a monetary policy perspective was, of course, the release of this FOMC minutes, right? Now, this is just a detailed overview of our July meeting. Why this is, in my opinion now, even more important is because of sort of the stance that Kevin Walsh is taking, right? He's not necessarily giving much to markets, right? He's being very reserved, and it's sort of our job now as traders to analyze this and try to zero in, try and focus on exactly what objectives these committee members, these officials are focusing on themselves, and sort of try and understand what the forefront of the discussion is, okay? And only that way can we sort of try and identify what's potentially going to dictate the Fed's rate path. Okay, so of course, I mean, most of you guys already know that the Fed, they maintain their 3.5 to 3.75% fund rate. Okay, but The minutes is sort of showing that policymakers were considerably concerned about inflation. Okay, so many participants assessed that policy tightening would likely be necessary if inflation didn't decline. Now, I do recommend highly that you guys go through this FOMC minutes yourselves and sort of you try and do your own due diligence. Try and understand exactly what you can maybe take away from this. But of course, the main points are going to be covered in this video, right? So yeah, like I said, several officials thought further tightening could essentially be necessary if inflation failed to move back towards the Fed's 2% target for their inflation, right? Now, 3 members actually dissented in favour of a 25 basis point hike at the meeting, okay? Now, why is that important? That's important because going into this period, a lot of the market conversation, it had all been about potential Fed easing, okay? And the minutes essentially told us, don't assume that the Fed is ready to cut. All right, they're not at the moment. They're not ready to cut just yet. Okay, they're in a very difficult situation, like we mentioned in the intro. It's a very difficult climate for them to sort of navigate through at the minute. Right. So the Fed is still looking at inflation and is prepared to sort of remain restrictive if necessary. That's the main thing. It's if it's necessary. It's if they decide that the inflation is particularly persistent. Okay, and this is where I sort of want to speak on this for a while, right? This is something you need to understand about macro trading. You're not necessarily trading the economic number itself, okay? The specific data print. You're not trading that, right? You're more so trading what the number does to expectations for interest rates. Okay, don't automatically go onto your economic calendar, see a bullish data print for the dollar, and think, okay, cool, now I'm bullish, right? Or if you see a lot of bullish economic data for the dollar, that naturally that means that the asset will trade higher. No, it's always in relation to that central bank's rate path. Okay, so that's the main thing. Think about this. This is how I would break it down to students, right? This is the chain that you're sort of following. You're following inflation data, which essentially leads on to Fed expectations, which then leads on to treasury yields, and of course that's going to have knock-on effects on the dollar, and of course we're all mostly trading dollar-related assets, so that's going to sort of drip feed into other asset classes, right? So you're focusing on data first, your inflation data, how that affects Fed expectations, how that's going to affect yields, and of course that's onto dollar and dollar onto the respective assets that you're trading, right? That's the main sequence or the chain that we want. Now, the interesting thing is that the Fed's sort of hawkish stance that they're beginning to take on here is happening while parts of the US economy are beginning to slow. And I'll link it back to what we said in the intro. Those two objectives, a weakening economy with a sticky, persistent inflation, they don't gel together. That's not what an economy wants to see, and that's not necessarily a good thing for central banks, because it sort of blurs the lines in regards to how they're going to move forward with their rate path. Okay. So, retail sales was down 0.6% in July, okay? And now that's important because consumer spending is a major component of the US economy, of course. We already know this, right? But, let's look at the housing data, okay? Housing starts fell 12.4% month on month in July, while single family starts fell 9.9%, okay? Now, you're probably asking yourself, Arjun, why does housing even matter, okay? And that's because housing is extremely sensitive to interest rates. Right? If mortgage rates are high, let's break this down properly, okay? If mortgage rates are high, that means mortgage costs are high. Mortgage costs are high, the demand for housing obviously will fall, right? It will decrease. And of course, that means less construction, less building new homes, right? Less construction, less economic activity, okay? Now, housing is one of those areas, and this is a very important thing, housing is one of those areas where we can actually see monetary policy feeding through into the real economy, right? We can genuinely see the effects, okay? Now, the last thing I want is for you to look at what I'm saying or hear what I'm saying and immediately say to yourself that the US economy is collapsing, okay? Because that's not what the data is actually telling us, right? Other parts of the economy, they remain relatively strong, okay? US services activity, like we can see here, actually accelerated, right? Now, the US economy has given us mixed signals. For me, that's the best way to put it. If I was to put a headline on this entire thing, I would say that it's just giving us mixed signals. We have housing weakening, right? So consumer spending is showing some weakness, but also services are remaining relatively strong, right? And on top of that, the labour market at the moment isn't collapsing, right? Now that's why the Fed has a luxury right, of being patient. If it didn't have that, we would be much more clued into what's actually happening, and there would be a clear objective and a clear rate path. Okay, we would understand if there were going to be rate hikes, that we would understand if there were going to be easing of this monetary policy, right? But at the moment, because of all these mixed signals that the economy has given us, we're not necessarily sure. Okay, that's why we're taking sort of everything in a stride, right? In our stride, we're trying to understand what are the major talking points and what's genuinely going to lead to upside valuations of the dollar and downside valuations of USD. Okay. Now, me personally, I think the US dollar is it's a very interesting asset to be trading at the minute, right? So let's sort of delve into it. What does all of this mean for the DXY? All right. What does it mean for the dollar index? We have these two competing forces, okay? And at the end of the day, let's be real, it's either a bearish US dollar, given the macro context, or it's a bullish US dollar based on the macro context, okay? So let's look into it. Let's see what that macro context would need to entail in order for this asset to trade lower, right? If we're looking to see this happen, right, we're looking to see this asset trade down to some of our sell side targets. I mean, this area is a key area for me, and of course this external low, right, at the start of this year. Now, what would we need to see? Economic growth would need to continue deteriorating. If that's what you're sort of following, and you're looking for this asset to continue trading lower, that's what's on the forefront of your mind. You're looking at economic growth figures, right, and you're looking to see if it continues to deteriorate. Right, and then off the back of that, markets are going to essentially start pricing in these future rate cuts. Okay. So we already know that rate expectations come lower. That's going to have knock-on effects on the treasury market. So our yields will also begin to fall, and that's going to, in line, make this asset trade lower. It's going to put some sell-side pressure on this asset. All right. But then there's also a different context, right? There's a different path that the dollar can take. Okay, we could begin to trade higher, right, and go for these buy side targets, right? These sort of internal highs within this entire range. Now, what would need to happen for that to be the case, right? Inflation, of course, it would be the main thing that we're looking at, right? We would essentially need inflation to remain very, very sticky, very persistent, right? And the biggest thing would be looking at the Fed remaining hawkish, okay? And I know that's not necessarily the vibe that we're getting from the Fed at the minute, but things can change, okay? But the main thing we've got to be looking at is them staying hawkish and these inflation figures coming out still fairly elevated, okay? And of course, rate expectations higher, the yield market will obviously trade higher as well, and of course that's going to lead to upside pressure on the US dollar, right? So the main thing here is that the dollar's direction, it's not simply about whether economic data is good or bad. You guys need to sort of get that out of your mind. Don't look at bullish data instantly meaning that this asset will trade higher, or bearish data, if you're on your economic calendar, you're seeing a bunch of reds, immediately thinking that the asset's going to trade lower. No, that's not necessarily how it works, okay? What we need to focus on is what the data does to the expected Fed rate path, right? That's the key takeaway here. So now let's sort of move over to the UK. The major UK release last week was, of course, CPI. Okay, UK inflation actually rose from 2.6% to 2.9%. Okay, in July. Now, I know most of you guys are probably looking at this, right? And this is where it goes into not reading the figure and actually genuinely looking at the report, doing a bit more than just that. Okay, most people will just look at the figure and think that they're trading macro, right? It's not as simple as that. You're going to look at this and think higher inflation, I mean bullish GDP, right? And to some extent, you guys are right, okay? Because of course, if inflation's higher, the Bank of England is going to have less room to aggressively cut their interest rates, yeah? But let's actually look underneath the headline. Everyone's looked at this. Everyone's seen that it's rose by 2.9%, up from 2.6% the previous month, okay? Everyone's already seen this. Let's look underneath. A significant part, right, of this increase came from this, right, from this figure, right, a higher household energy cost. Now, this isn't necessarily evidence that British consumers suddenly they have a huge amount of spending power and they're the ones that are driving this demand-driven inflation. It's partly a cost shock, okay, and that's in my opinion, a very important distinction to make, okay, because when we're looking at these figures, this increase in CPI, a bullish, well, quote unquote bullish CPI figure. Let's actually see what led to that figure being the print, right? And it's important to make this distinction and look at figures like this, because central banks can't solve an energy shock very easily with interest rates, right? I mean, you can raise the rates and reduce demand. You can't directly create more energy supply, can you? Right, so that's just something to sort of take into account off the back of the inflation data that we got for the UK. And then we have the UK labour market, right? And now this is the other side of the coin. So we've looked at the inflation figures. We're trying to come to some sort of a conclusion as to how it can affect the Bank of England, the Bank of England's monetary policy and their rate path. But let's look at the labour market. At the moment, it's, from what we can tell, it's been cooling, right? It's been cooling down. The unemployment rate was 4.9%. Well, I mean, vacancies were down as well, down 6,000 to around 707,000. Okay, so the Bank of England is facing a very similar problem to the Fed. Right, inflation's still elevated, but this economic momentum is weakening. So they're in a, from what I can tell, a very similar situation. Right, now that makes future Bank of England policy a little bit more difficult to predict, right? So for GBP, for the pound sterling, I'm not going to automatically say inflation's up, therefore the pound is bullish. I'd much rather be saying a higher inflation is supportive for GBP, for the pound sterling, through interest rate expectations, right? But weakening growth and employment will create that significant sort of counterweight, okay? So I think making that distinction is very important. And I mean, at the same time, we've also got retail sales data, right? I mean, retail sales volumes fell around 0.5% in July. Now, again, that's another sign that the UK consumer isn't that strong. It's not particularly strong. So we're getting an interesting picture, in my opinion. We're getting inflation higher, consumer spending lower, labour market momentum also lower. That's not ideal. We know this, but that's not an ideal combination for the Bank of England. I mean, I know we did just receive some fairly encouraging UK PMI data, but I mean, again, the UK economy it's not collapsing, right? It's simply becoming more mixed. It's the same exact thing. I mean, at the moment, it's mixed. So all we can do is try and ascertain what objectives are sort of at the forefront of these central banks' discussions, right? And see what the more important data is to sort of focus on, and to see if the labour market is cooling at a more aggressive rate than this inflation data is remaining elevated. So let's talk about sort of Europe. I mean, the Eurozone had a surprisingly strong week, right? This was actually one of the more interesting developments. So composite PMI, I mean, came in around 52.1, and we saw this manufacturing improved quite significantly, right? We saw manufacturing PMI up to more than a 4-year high of 52.8. Now, remember, with PMI, above 50 is expansion in the economy, and below 50 is contraction in the economy, right? So what are we seeing? What's the evidence? It's sort of hinting to us that the European economy is gaining momentum, right? And at the same time, inflation has been moving higher. Let's actually have a look at the data. I mean, inflation, Eurozone inflation, reaching around 2.9%. So Europe currently has a relatively interesting combination, right? We've got growth improving and inflation remaining elevated. From an ECB perspective, that's not necessarily a reason to aggressively ease policy. If anything, that's just providing support for the euro. Of course, one thing that you would have to take into account here is that the ECB's fund rate currently is around a whole basis point below that of the Fed and the Bank of England, right? That's just something to take into account. But if we look at Euro USD, if we actually go to the chart, I mean, here's my sort of thing with it, right? When you're trading Euro USD, remember you're effectively comparing two economies, right? You're not just saying to yourself, I mean, is Europe strong? No. You're pairing, essentially, Europe versus US, okay? You're pairing these two economies together, right? This is the main thing. This is essentially what you're trading. So, what I would do is essentially analyze if European growth continues to improve, and at the same time, in the same sort of breath, we're seeing US growth deteriorate. That can cause upside pressure in euro, right? So that could lead to euro bullish. But of course, in the same sentence as well, we have to understand that if the Fed remains significantly more hawkish than the ECB, then it comes back to that interest rate differential trade, right? We can have that favour the US dollar, right? So for Euro USD, this is my main thing. This is what I'm watching. I'm watching US yields against EU yields, and of course the relative economic data, right? I think that is going to be paramount in actually understanding whether or not Euro USD is a bullish or a bearish asset. And that's pretty much most of what I wanted to speak about. I mean, now we're on sort of the headline topic, right? I feel like this is what everyone's probably waiting for. It's Treasury yields and the $4 billion buyback announcement that caused that sell-off of the dollar, right? Now, it's one of the most important things that I want everyone to understand from last week, because it ties together. It ties together treasuries, yields, the dollar, gold, and indices, okay? So, on Wednesday, the US Treasury announced that it was going to at least double the size of its liquidity support buyback operations, right? And specifically for longer dated Treasury securities, okay? So, previously, the maximum was around $2 billion per operation, and it will be at least $4 billion per operation, okay, beginning September 9th. Now, these buybacks will focus specifically on the 10 to 20 year sector and the 20 to 30 year maturity sectors, okay? So it's particularly relevant to the long end of the Treasury curve. Now, you're probably asking yourself, why did they do this? Why did the US Treasury even implement this? Now, to understand the announcement, we need to understand what's been happening in the bond market, right? The long end of the US Treasury curve has been under significant pressure. So let's actually have a look. I mean, the US 30 year is probably a good area to start. So the 30-year Treasury yields, they've reached roughly a 19-year high. I mean, you can see the levels that we're at. I'm on a monthly chart. We're at levels from around 2007, okay? Also, the 10-year was also fairly elevated, okay? Now, that's a problem for the US government, because think about it. Higher Treasury yields, what does that mean? That means the government has to pay more to borrow money, right? But it's also a problem for the broader economy, right? This is what I want to focus on, right? Because Treasury yields, they influence everything. They influence mortgage rates, corporate borrowing costs, consumers if they're looking to sort of borrow money, so consumer lending, equity valuations. So the main gist of it, what it's affecting is this: financial conditions. That's the big thing. It's financial conditions that are being affected, right? So, when long-term yields rise aggressively, right, like we're seeing in these markets, these financial conditions tighten, and it's happening regardless or irrespective of whether or not the Federal Reserve is even changing its policy rate. So the Fed can stay unchanged. You know, they don't necessarily have to hike or ease, all right, or cut. But regardless, we're seeing financial conditions tighten because of these markets, right? And that's why it's so important. So, I mean, what exactly is this entire Treasury buyback program, right? So the US government issued enormous amounts of Treasury debt over the years, right? And some of those bonds that they've issued, they're relatively old, right? They're not particularly liquid anymore, right? So what the Treasury does, they essentially go into the market and they say, look, we'll buy some of these older bonds back from you, and that's the Treasury buyback. They're going to buy those outdated bonds, okay? They're not giving the market just free money. It's buying existing government debt from these investors, right? And the reason I sort of highlight liquidity support is because that's the purpose. The purpose of this particular program is to improve liquidity in these older, less actively traded securities, right? And I mean, from what I can remember, I believe in their last operation, investors offered up what equated to around $20 billion worth of outdated securities. So investors were looking to sell off around what equated to around $20 billion worth of these long end treasuries, right? But of course, I mean, US treasuries can only align to whatever their buyback limit is, which was at the time $2 billion, right? So of course that's highlighting that disparity there. I mean, if they can only buy back $2 billion, but investors are looking to sell off around $20 billion, there's a liquidity issue, right? So how does this, I mean, what effect does this have on yields, right? And in my opinion, this is where it gets pretty interesting. So I would definitely make notes on this, because this is important just to know regardless, right? But it's important to know how these markets are sort of affecting what assets you're trading. Now, imagine investors are holding some older treasury bonds. Imagine I've got some older treasury bonds and they're not trading very efficiently. The treasury is going to come to me as basically as a buyer, I'm the seller, and they're going to create that additional demand for those securities, right? So with this increased buyback operation from 2 billion to 4 billion, they're essentially acting as that buyer. They're creating more demand artificially. They're creating more demand for these securities. So the demand for these bonds goes higher. But what does that do to bond prices? That increases bond prices. Bond prices go higher, the bond yields go lower. That's a basic mechanism, right? But there's also another important effect that I want you guys to understand. The Treasury can effectively replace these older off-the-run securities with slightly more liquid versions of these securities that they've just bought back, right? And that improves the functioning of these long-end Treasury markets, right? And that's why I sort of zeroed in on that idea of it being liquidity support, because rather than a simple monetary policy tool, it's sort of looking to basically make this market more efficient, right? And alleviate some of the pressure. So let's actually look at the chart. I mean, what was the immediate reaction? And in my opinion, it was fairly straightforward. But what happened after was what I'd want to sort of bring to your guys' attention. Okay, so basic market mechanics, right? Treasury prices rallying because of this increased demand that's artificially come from the US Treasury. So prices are going to rally and yields are going to move lower, right? They've got that sort of inverse relationship between bond prices and yields. So because these yields were falling, we saw support for these risk assets and commodities. Like that's why we saw gold fly. That's why we saw upside pressure in crypto assets and of course indices as well. But here's the important part, in my opinion, right? The move didn't solve the underlying problem, and I mean the market literally showed us that, right? The market showed us that it's not solving anything. It's an artificial alleviation of essentially short-term alleviation of these effects, right? So 10-year and 30-year yields basically moved straight back. They moved back towards their elevated levels. So if you're thinking of it as like a conversation, the markets essentially said, right, cool, this helps, but it's not fixing the underlying fiscal problem, right? And that's a good distinction to sort of make there, right? It's what initially happened, the market's reaction to it. Of course, this is basic market mechanics, but this is the market's reaction to that sort of announcement, essentially, right? Now, why is the market still worried about this? I mean, the US government has an enormous amounts of debt that it needs to be financed, right? What's the US national debt at the moment? It's now past 40 trillion US dollars, right? And if the government continues to issue significant amounts of debt while investors are demanding these sort of high yields in these long-end markets, then the cost of servicing that debt is obviously going to increase, right? So you get this feedback loop. And this is essentially how I'd want you guys to understand it. I mean, this large fiscal deficit that the US is incurring, sort of day by day, week on week, month on month, year on year, is leading to more treasury issuance, more supply of bonds, but then these investors are demanding higher yields, so the government borrowing costs is increasing. And then of course the debt servicing at the end of the day, that cost increases, right? So that's one of the reasons the long end of the treasury curve has been under some significant pressure, right? Now, the buyback this sort of program that the Treasury has implemented, yes, it can improve liquidity, right? That's the main goal of it. Like we said, we differentiated. It's a liquidity issue in this market. It's not necessarily meant to be a tool to affect, to be used for monetary policy. That's not the reason. Otherwise, the Fed would have got involved, right? It's the US Treasury that have got involved. They're looking to improve liquidity within these markets, right? But remember, they're trying to improve liquidity, but it doesn't eliminate that underlying fiscal deficit, right? Or the amount of debt that needs to actually be financed, right, by the US economy. Now, that's why investors aren't. The reason why they're worried is because they're not simply treating the announcement as a permanent solution. And it doesn't take a genius to literally look at this market and for the market to essentially tell you that. I mean, this announcement was on Wednesday, midday, and you can see by the end of the week, we were essentially back to those pre-announcement levels, right? So let's try and link this back to the Fed now, right? What does this matter? How does this matter? How does this market, the US 10-year, these long-end bonds, these Treasury markets, how does it affect the Fed? And this is where it gets interesting, right? So the Treasury controls this fiscal and debt management policy, but the Fed controls monetary policy. They're completely separate institutions, right? Let's actually put it up. You've got the Fed. You've got the Fed on one side, of course, they're controlling your monetary policy, and then you've got the US Treasury, right? Two completely separate entities, right? But how can one's actions maybe affect the other, right? the Fed is going to influence these short-term interest rates, right? And the Treasury is sort of dealing with the government's financing requirements. So if these yields are rising, like we're seeing on the high time frames on this market, right? And investors are demanding more compensation for holding long-term government debt, the Fed can't necessarily solve that by just cutting rates. That's not necessarily how it works, right? So what you could have is, because remember, the reason why these markets are moving to the upside, these long-end Treasury markets are moving to the upside, is because of the underlying fiscal sort of issues, right? The fiscal problem. So what you could have happen is the Fed rate comes lower, but the 10-year and 30-year yields remain high. Now, this is what you need to understand. So the long end of the curve is influenced by more than just the Fed, right? These markets that we're seeing, the 10-year, 20-year, 30-year, it's not just inflation expectations, right? It's also fiscal policy. It's Treasury issuance, economic growth, demand, and sort of the investors' positioning, right? Now, let's try our best to sort of link this back to the DXY, right? Because at the end of the day, this is sort of what we're looking to see happen. This is what we're trying to trade, right? We're trying to see upside pressure, downside pressure in this asset, all right? Now, what does this mean for the DXY? Okay, of course, this is where it becomes a little bit more complex, right? In theory, if we're looking at it, with these markets, the Treasury market, lower Treasury yields, they're going to reduce the attractiveness of these US assets. These are things that we've been through before, right? And obviously that's going to put pressure on the dollar. So the sort of chain of reasoning here, the sequence, is of course these Treasury buybacks going to, of course, increase bond prices because the demand for these bonds is increasing artificially, quote unquote, but who cares? Bond prices are going higher, yields are going lower, potentially weaker dollar, right? Now that's one of the reasons that the announcement sort of generated discussion around the dollar, right? I believe there was a Reuters report that sort of said it's sort of created discussion now regarding dollar depreciation, okay? Dollar depreciation. So we'll be looking at these sell side targets, right? Of course, if the dollar continues to depreciate, right? Particularly, and this is the main thing, if investors view what happened in this Treasury market, in these long end Treasury markets, if investors are viewing this as an attempt to suppress these long-term yields, then it's going to lead to sell-side pressure on the dollar, right? But my main thing is at the moment, I'm not automatically assuming anything. I'm not assuming that these buybacks mean that the dollar is bearish, right? Because if Treasury yields are falling due to these markets, the 30-year, 20-year, 10-year, if these sort of long-end maturity sectors are performing more efficiently, right, and on top of that, the Fed remains relatively hawkish, then of course the USD can still remain supported, right? And it could put buy-side pressure on that asset, right? So again, it's always macro context. It's that context that matters, right? Now, my sort of bread and butter. Let's focus on my favorite asset. Let's look at what it means for gold. In my opinion, it's a lot more straightforward on this, right? Gold doesn't pay interest. So when we're seeing these yields rise, the opportunity cost of holding gold increases, right? So if Treasury yields are falling, the opportunity cost of holding gold goes lower, and that's obviously going to support gold. That's going to lead to more bullish momentum in this asset, right? Now, in the same breath, at the same time, right, if the market is also becoming concerned about US debt, which, by the way, these are all talking points now, US debt, fiscal deficits, the actual purchasing power of the dollar, right? If the market starts to have doubts and concerns about these aspects, and even on top of that, of course, the geopolitical risk, that's always something, gold is going to receive that additional safe haven bid, right? And what I mean by that safe haven bid, is there will be capital rotation back towards this asset because of those sort of topics that I just mentioned, right? So this entire announcement, the way I'm looking at it, is potentially creating a much more supportive, much more bullish environment for gold, right? And the main thing to look at, the main thing I'm looking at is just if this entire thing results in sustained lower yields and weaker real yields, of course we're going to see continued upside pressure, right? We're going to see that continued bullish momentum, right? And we're going to look to target those buy side targets, right? But again, remember, we need to watch the actual bond market rather than just looking at a single headline announcement, right? Look into the intricacies of sort of what it means for markets in general. So the final sort of takeaway, if there's one thing that you're going to remember from this week's commentary, it should be this, right? Don't trade the economic data. I want you to be trading the change in expectations, right? Strong number, like whatever newsprint it is, a strong number doesn't automatically mean bullish, and a weak number doesn't automatically mean bearish. You need to be asking yourself, right? What does this change about interest rate expectations, right? And then, of course, what happens to these markets? What happens to yields? Because it's such a big talking point at the minute, right? And then, of course, what happens to the currency, right? And finally, how does that flow? How does that flow through into gold? How does that flow through into indices, commodities, and overall risk sentiment? Right, that's the macro chain. That's what I'm sort of subscribing to at the minute. Right, so going into the week, I don't want you to be thinking, is the US economy strong or weak? This is exactly it, and this is the question that I've basically got on the forefront of my mind. Right, does the market believe inflation or growth to be the bigger problem for the Fed? Right. And then, of course, you act accordingly, right? If inflation wins that battle because of, let's say we start to tilt towards inflation being the bigger problem because of whatever news announcements we get and whatever data we're fed, right? If inflation begins to win that battle, hawkish Fed. Yields are going to obviously trade higher, dollar stronger, pressure on gold and equities. But if growth is sort of deteriorating and we see growth is sort of winning that battle, then it's a dovish Fed. Yields are going to go lower, dollar is going to become weaker, and that's support for gold, equities, and FX, right? That's ultimately the macro narrative that I'm watching, right? In a nutshell. So it's data onto expectations, that's going to lead onto yields, and then of course FX and asset prices, right? That's the framework I'm going to recommend everyone who's watching this video should use whilst they're sort of analysing the economic calendar this week. So that's pretty much it. I'm going to wrap it up now. I hope you boys have a really good week trading. And if you've got any questions about sort of topics that I went over throughout this weekly commentary, feel free to either drop me or Aaron a message on the Discord. Alright then, boys. Have a good week.